Hi, this is Brandon Bischoff with Canterbury Investment Management. This is the Canterbury Market Update for the week of March 2nd, 2020. And so starting with the overall market environment, we are still in a transitional market state. And it was a wild week for the equity markets last week. And just 6 trading days ago, the S&P 500 was sitting at a new all-time high, with low volatility. And then last week, it's like a trap door opened and the market kind of fell right through it. The coronavirus certainly has people kind of freaking out. And if we look at history and we look at our lives, just 10 years ago or 100 years ago, 200 or even 1,000 years ago, there's been many advancements in transportation and technology and the applications in medicine and all these different areas of our lives. The one thing that, however, hasn't changed is human emotion. All liquid traded securities and markets are driven by supply and demand. And supply and demand are counterintuitive, often doing the exact opposite of what most people would expect. Supply and demand is driven by investors' emotions and beliefs about the future. And sometimes emotions become, erratic and can kind of overtake logic and reason and cause, a market event similar to what we're seeing right now. And we've seen, a few instances of this in the past. And markets, rarely repeat themselves, but they do often rhyme. And so most recently would be the kind of thing we saw in December of 2018. If you remember, the market was, sitting about 10% off of its peak at the time, and then it just shot another 10% down over like 7 days, and then rebounded back like nothing had ever happened, and in fact, a few months later put in a new high. Similar again would be the flash crash of 2010. In May of 2010, the market actually dropped 10% in one trading day, but then rallied back before the close and ended, much better off. In fact, Procter & Gamble at one point during the trading day was down 25%. Didn't end there. It actually came off of it. It was a trading anomaly. So the point here we're trying to make is that, markets can do many crazy things because people can be emotional and make irrational decisions. And many studies show that markets, they don't go from bull to bear overnight like, the news media might be telling you. It requires a process. There will be kickbacks. There will be, certain things that have to occur for markets to actually enter into a bear market. Canterbury Volatility Index did increase. It currently measures CVI 99. Almost 5 trading days last week were actually considered, outlier days beyond plus or minus 1.5%. In fact, if you would have checked your phone at one point during any of the trading days last week and then checked it 30 minutes later, I'm sure the market was probably at a completely different point. The market was really, really emotional throughout the trading days last week. But, outlier days, if we said in the past, they don't actually occur, evenly distributed. It's not like you go 3 months and get an outlier day, and then another 3 months before you see another one. They occur back to back to back, and will go both ways. So just because last week saw a bunch of outlier days in a row that were all down, those outlier days will happen on the upside as well. In fact, even in the worst of bear markets, so like even in 2008 during the middle of a bear market, which we're not in right now, 42% of the outlier days were actually up days, and volatility was much higher at that time. And then as a quick observation, what we have on the chart here, this is a 10-day Canterbury Volatility Index with the S&P 500 going back to 2015. And what we can see is that there's 4 instances on this chart, including today, where the Canterbury Volatility Index, or the short-term Canterbury Volatility Index, which is much faster moving, reached a volatility level of 200, which is where it was sitting at, after Friday's close. And you can see that's, been pretty typical of actually identifying sort of a bottom in the market. Somewhere around that 200 level is usually the bottom. Not making any predictions, I'm just saying that is an observation to look at. So even with the recent volatility spikes in the market, there's still a few technical positives to kind of take away. And we're going to start with the advanced decline line, which measures market breadth. It shows the number of stocks going down versus the stocks going up. And so when the market's at a high, like it was, 2 weeks ago or a week ago Thursday, the advanced decline line was also relatively at a new high. And so what that's saying is, rather than just a few larger weighted stocks pulling the market upward, basically there was broad participation. In both the bear markets of 2000 and 2008, you actually saw the market putting in, peaks while the advanced decline line was declining, meaning just a few stocks were leading those rallies rather than having broad participation among stocks. That is not the case today. Last week when we had the market high, There was, the advanced decline line was also at a high. Another thing to take away here, stocks are currently oversold. So our good friend and market technician, David Voman, wrote about in his weekly update that the percentage of stocks giving AIQ buy signals is at 97%, which is a deeply oversold reading, meaning stocks can only fall so far so fast before sort of getting a pop. It's like the stretching of a rubber band. The further you stretch it, the more likely it is to sort of snap back a little bit. And so, with stocks being 97% oversold, that is, somewhat of a buy signal there. And lastly, the NASDAQ is still leading the S&P 500. We've talked about it in, weekly updates in the past that we want to see the NASDAQ outperforming the S&P on a relative basis. It shows investors are willing to take a little bit more perceived risk when it comes to investing. And even during the sharp downfall we saw last week, the NASDAQ is still leading the S&P on a relative basis, which is something you might not expect, but that's the reality of what's happening. The S&P is still behind the NASDAQ, which is good. And just on an interesting note, China, which is said to be the source of the coronavirus, actually outperformed the equity market on a relative basis last week. China's been in more of a bearish environment with a little bit of whipsaws, but while global equity markets kind of reached new lows last week, China did not actually put in a new low. That's just a side tidbit there. Portfolio efficiency, this is an important topic. Our Canterbury portfolio efficiency score is currently in kind of a transitional state. And there's a reason behind this. You can see the volatility is a little bit higher at CVI 70, and the benefit of diversification is lower than it has been in the past at 20% because the equity markets were kind of all going down together, meaning they're a little bit more correlated. And, it's due to the type of trend of market we're currently seeing. We are experiencing similar events as what we saw in 2018 or in the flash crash, where you have these sort of trading anomaly type thing where the market drops super fast and then eventually has to get some sort of kickback rally. So what we don't want to do is we don't want to make the portfolio immediately efficient on that sharp, quick, fast drawdown. And that's because if we make it immediately efficient and sort of stabilize the portfolio, you miss those kickback rallies, you miss those sharp advances, and you ultimately get whipsawed. So by making the portfolio immediately efficient, you'd miss out on any kickback rallies. What we want to do is we want to navigate this volatile environment by letting the market try to figure out where it wants to be. Because right now it's erratic, it's emotional, and it's dropping fast, but it's gonna kick back just as quickly. And when that happens, then we can start to make the portfolio more efficient. But that kind of brings us to the end of this week's Canterbury Market Update. Thank you, and I hope you have a great week.